everyone. Thank you so much for joining us once again here at Seafried & Brew for our economic briefing. I am Jamie Sumner, Chief Analyst, and for today, we're going to look over the Fed's release that came out yesterday. It was decision day. We'll talk a little bit about their Fed, the balance sheet, their projections, and look at the GDP projections from a number of different sources and the projection out into the future and how long this recovery will take. So let's jump right in. The Fed came out yesterday. Chairman Powell stood up there, read the statement. First statement, of course, the Federal Reserve is committed to using its full range of tools to support the U.S. economy. Its full range of tools. That's a substantial toolbox that they're utilizing. In fact, he continued to say in his press release that we will continue to use these powers forcefully, proactively, and aggressively until we are confident that we are solidly on the road to recovery. And we've heard him say that statement before, and that has been backed up with action. We see what the toolbox that they were utilizing prior to the pandemic. And notice there are 6 different tools that they were utilizing. After the pandemic occurred, then we started to see more and more tools being taken out of the box and utilized, and we added 11 different items here in a total of up to $2.3 trillion in aid. So substantial amount of money that they're able to utilize. However, this is not it. If you recall, in the CARES Act, the Congress actually told Treasury to provide $454 billion to the Fed to utilize. Now, the Fed can leverage that up just like a bank can. And if they leverage that 10 times, which is typical for them, that gives them the power to turn that money, not to $2.3 trillion, but $4.5 trillion. So that's the total amount that they could potentially give out in aid, $4.5 trillion. Now remember, that's above and beyond any of the fiscal stimulus that we see going on. So when we look at the different tools and we see the impact of the Fed's balance sheet, we are up to $7.1, almost $7.2 trillion on the Fed's balance sheet. Prior to that, after the Great Recession, with the different quantitative easing programs, they got up to $4.5 trillion. So if we look at the numbers, we could potentially get up to a little over $8 trillion in the Fed's balance sheet. So we have to take that in consideration and think about how that's going to impact not only just the equity market, but also the interest rate market. And we've seen that whenever the Fed goes out and starts buying up these treasuries and mortgage backs, the rates will go down and they will remain down. And that's what their ultimate goal is to manage that yield curve, not only on the short end of the curve with the Fed funds rate, but on the long end of the curve with their asset purchases. So where we are today with the 10-year back down to that 0.8 range. If you recall, it popped up above 0.9 last week, and now we brought it back down. So that's where we are today. We can continue to see these low rates into the future. We talked about that last week. But let's continue on with the Fed's statement. They go on to say, about the outbreak. It's a tremendous human and economic hardships. We've seen that, and we will continue to see that occur until we have a full opening and everything gets back and roaring. However, I believe it's going to be a fairly long time until we see that full recovery. And we'll talk about that in a minute. But overall, we know that the Fed, they're committed to the price stability and employment, full employment. So they maintained their overall Fed funds rate at 0 to 0.25%. So no change in the Fed funds rate there. Let's look out into the future. They did give their projections, and we saw the dot plot. If you recall, the last time back in March, they were supposed to release this. They did not, but they did in that emergency meeting reduce the Fed funds down to 0. And we see here, zoom into the bottom, no real change in Fed funds for the next several years. And that's what we've been saying, that this low interest rate environment is not going to be a couple of quarters, but it's going to be years. And we know that that is what the Fed individuals are thinking as well. So we look at that going out to 2022, Fed funds rate maintaining 0 to 0.25. And that shouldn't surprise us. The last time we were down here at these levels, we were down here, if you recall, for 83 months. Now, let's look at the rest of their projections. In terms of GDP for 2020, they came in at negative 6.5%. Then we have a rebound in 2021 with a positive of 5%, and then 3.5% in 2022. So we see the overall level at that negative for the year. Now this is for the year, not for the second quarter. This is for the entire year of 2020, negative 6.5%. Unemployment rate they look at coming down to 9.3 by the end of the year, and then going out to 2022, it being at 5.5. Inflation, no real issue, below that 2% level. In fact, at the end of the year, their PC inflation expectation is 0.8, and the core is 1%. So we continue to live with little inflation. Now remember, the Fed is trying to produce that inflation back up to the 2% level, and they do that by keeping rates low and with these quantitative easing. What they don't want here is a deflationary instance, and that's what they're striving to protect us against. When we look at another projection of GDP, this came out yesterday. The World Bank put out there, the United States coming down for 2020 at negative 6.1%. So if we look at this in terms of the GDP in total and looking out into the future, and we gauge a recovery of when we get back up to our normal trend line. So what I did is I put these different projections up here. We have the IMF projection. That was out in April. So we have their projection. The blue line would be the 2019 GDP projected forward then by 2% growth on a quarterly basis. So when we look at that, that would be the trend line. If we look at the IMF projections for the rest of this year and then next year, and then carrying that out into the future, we can see even into 2022, we still do not have a full recovery. In fact, full recovery does not happen until 2024. If we look at the World Bank's projection moving out into the future, that full recovery would happen in 2025. Now with the Fed, is a little better, with the Fed's recovery here growing at the 5% in 2021 and at 3.5 in 2022. We can see that doesn't meet at the end of this period full recovery. In fact, it would get out to 2023 is when we would have a full recovery. Now, that's pretty aggressive when we start to think about it. However, as we move forward and we can project out, perhaps we'll get back to that 10-year average growth rate in GDP, which was 2.3%. So if we look into the future And we project out a 2.3% growth rate starting in 2021. We can see a full recovery does not happen until 2048. So that is a long time for recovery to occur. So that's something to keep in mind as we're moving forward in here and we are looking at the different growth rates. This is all going to be contingent, of course, on how quickly we can get everything open and up to speed. This is a map put out by the Washington Post. Some good information, the link's down here, but it shows the different states and the state at which they are in terms of opening and state restrictions. Obviously, New York and New Jersey at this time are still under major restrictions, but as we move into the West, the Midwest, and then the West, we kind of start clearing up. Here in Pennsylvania, we just reached the yellow stage last week. That is a positive. We start to see things open. And in a couple of weeks, I'll be heading down to Virginia. So as I'm down there, I will see how that is opening up as well. But when we look at the United States, we do see a lot of these states that are in that minor restriction area. And that's the positive, is we're starting to see this open up. Of course, the risk that they put out there is that second wave happening in the fall because everything begins to open and we just don't know what's going to happen with that until we reach that fall area. But this is where we are for now. Next week, we'll talk a little bit about credit risk and how we might be able to gauge the potential losses in the portfolio and look at the important credit shock analysis that we provide our banks in terms of how you can look at the impact your capital could have with this credit cycle. So that's what we have for you today. We look forward to speaking to you next week. Have a great week, everyone.